Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, November 26th, 2:25 p.m. Eastern Time, coming to you from Mantua, New Jersey, with tonight's Revere Market Insight video. I actually should say this afternoon's Market Insight video. The market's closed at 1 p.m. Eastern today on a shortened day after Thanksgiving. The markets certainly were not in a giving mood today, as over the past 2 days, the emergence of a new COVID variant called, ironically, new, NU, that's the term being given to it from the Greek alphabet by the World Health Organization. So anyway, a lot of panic overnight, as this is apparently very contagious and has like 30 mutations on the spike protein. Preliminary, some of the things that I read said it's not overly, it doesn't sicken you worse than some of the other ones, but it is contagious. But we all know that the pro-lockdown people focus on cases, and the market certainly had enough fear instilled into it overnight to show some extremely red readings throughout the day. So we also, after the gap down about 1.5%, we closed near the lows of the day. You can see over here, we've downgraded the market state to a pullback as of today, and downgraded the short-term trend to neutral, arrow pointing towards red on short term and also on leaders. Leaders actually not that bad today relative to the indexes. It was mostly oils and banks and any reopen plays that got hit very hard today. We're still in an uptrend across our intermediate term time frame. That means where are the indexes relative to the 50-day moving average, and also long-term over the 200-day moving average. So the numbers on the day, G5, the growth index, down 1.9%, actually a pretty good, as I mentioned, reading relative to what the rest of the indexes are doing. S&P down 2.3%, NASDAQ 100 down 1.9%, Dow down 2.5%, mid caps down 3.2%, Russell small caps down 3.7%. We'll go to the market facts here in a moment and then look at some charts. But first, we'll take a look at the team here at Revere. Tough day at Revere today, as we were mildly overweight energy and financials coming in, and with them taking the hardest hit, we were down about 2.7, 2.8% on the day, so slightly worse than the S&P 500. However, we've got stops in place, and we're about 2.5 to 3.5% away from getting stopped out should the market continue to go to the downside. And I'll talk about that after I review the updated 21 over 21 list. And if you're interested in an active manager that has your back in times like this, we don't know if today put in a bottom. We don't know if we're going to continue to go lower, but we do know that we've got a plan for every holding that we have in-house. And when our stops get hit, it's that simple. We step aside. We want to participate strongly in the market when it's in an uptrend, when there's a bunch of selling going on. Even if it's panic selling at times, sometimes we try to separate panic selling from true selling. There was definitely some panic involved today, and we did get stopped out on a couple of things, but we do stick to our stops. And we also have a plan for entering, if the market rights itself, some positions that we've been taking a look at. If you're interested in this approach, you can reach out to any of us. Just email us. It's our first name and then at revereasset.com. So Dan, Tim, Hunter, Mural, Alex, or Don at revereasset.com, or you can phone 855 Real Wealth. That's 855-732-5932. So couple of things I want to point out here, some things that are the fear and greed index, first of all, dropped quite a bit from 64 all the way down, where greed all the way down to 35 fear. So you can see some fear definitely instilled in the market with this news, and also the put call ratio spiked up 201. Sorry, the put call ratio spiked up to a 1. As you can see here, 1 early in the day, and by the close, stayed in the 0.9s or 1. So those are actually contrarian bullish for the market. When you've got sentiment showing fear, that's good. You don't want to have a totally complacent market. So let's check some market facts here, and then we'll check some index charts. As I mentioned, downgraded the market state to a pullback. The dollar and rising rates were certainly headwinds for the market recently, but that went out the window today as interest rates dropped, as the price of bonds spiked, and in a race to risk off, so to speak. So definitely today is a counter trend for interest rates and the dollar. I mentioned the put call spike to a 1, fear and greed dropped to a 35. Our bull case continued to be staying over the 21 and the 50. The 21 has been pierced now for all of the indexes. So now we focus on the 50-day moving average and also the prior all-time high, which is the breakout pivot. So the bear case failed breakout. You can see here break below the prior all-time high pivot of 45.46. What would we do in the portfolio today? Late in the day, so let's talk about our risk exposure. We came in with a Revere volatility factor. I've talked about this. This is taking a look at all the holdings, their average true range, and their beta, coming up with a value that will compare it to the S&P 500. The S&P 500 is a 1.0. Our portfolio came in weighted toward risk at a 1.42 by the end of the day. We dropped it to a 1, which is where we want to be when we're below the short-term moving average, but still above the 50-day moving average. QLD offered a good risk reward late in the day here with a stop below today's low. If today should end up just being a one-day panic shakeout, we did hedge, as is our part of our strategy, half of our S&P, our SSO position, and it's mechanical. We have a close below the 21-day moving average. We hedge half of it, so we did that using SPXS, and we sold our banks and bank financial exposure FAS and our energy exposure NRGU as well as SU. Strong sectors today: bonds and healthcare still finished in the red, but just slightly in the red, and definitely on the downside. Oils, banks, reopen plays, and crypto. So we closed at 45.95. Let's take a look here at the S&P 500. Let me blow this up a little bit, and you can see very clearly the move below and the now rolled over 21-day exponential moving average, change in character. Certainly for the S&P 500, the next key level, not too far down, is this 45.46 area, and we've also got the S&P 500 50-day moving average rising. It's at 45.28. So this should provide, we deal in probabilities here and facts. There's no guarantees ever of anything in the market. Should provide support on a pullback, or at least a pause, where maybe we can build a sideways consolidation and possibly run into year end. That's one scenario. The other scenario is we continue to pull back. More damage gets made to some charts that got damaged today and earlier this week, when we had a big outside negative reversal in growth stocks. And if that continues, then our stops will get taken out. We'll get to cash. We'll let the market sort itself out, and we always have a plan to re-enter. So ADMA rolled over, falling now. That's the purple line. 21-day rolled over now. First close below it. That's the green line. Prior all-time high, 45.46. 45.27 right here, you're rising. 50-day moving average. Those are the two levels that we're focusing on now, looking for support to come into the market. And if you go down, worst case on our exit, we will be, you can see the 200-day moving average at 42.90. So that's rising up toward this prior low here. That would be the next area of interest for us. should we continue to break down, and that's a double level of support prior lows during the most recent correction in late September, early October, and the 200-day moving average. The markets never get in a serious bear phase unless you get a sustained break of the 200-day long-term moving average. That's the black line there. So that covers all of the facts relative to the S&P 500. Let's take a look at the rest of the major indexes. Here's your NASDAQ 100. Undercut bounced, looked like it was going to get back above the 21-day moving average late in the day, but a weak close got us back below it. We do have a 5% position in a QLD, though, with a stop below today's low. Dow Jones Industrial Average, really had my eye on this early in the week for a break above this 359.40-ish area, and just couldn't get above it. And then with the big gap down today, there was really no safety in Dow stocks, as it's heavy in financials and oils, and those certainly got hit. So first close below the 50-day moving average on the Dow Jones Industrial Average. Let's go to mid-caps. MDY sitting right on the 50-day moving average, undercut it during the day, closed back above it. You can see the 21 rolling over there also. And finally, small caps. Nowhere to hide in small caps today. One closed below the 200-day moving average. Really took a beating today. Didn't matter if it was growth or value. The IWO, this was by far the worst of the 5 components of the G5 index. You can see that with its first close below the 200-day moving average. IWN, as in Nancy, the value component, undercut but bounced right above the 200-day moving average. So no good coming from small capville right about now. So let's switch to the 21 over 21 list. 10 stocks punted this week. Let's go through what broke down. First of all, we've got Snow. Still a decent looking chart, but the 21 has rolled over. It bounced off the 50-day moving average. Bill, same situation, bounced off the 50, but the 21 has rolled over. Dexcom, which we got stopped out of this week, same situation, bounced at the 50, 21 has rolled over. Airbnb, you know, if it's a reopen play, you're not doing too well. Below the 21 and the 50, bounced at the 200 today. Franco-Nevada gold stocks, gold was slightly positive today, but gold stocks not showing any strength. This one now breaking the 200-day moving average, taken off the list. Ambarella, we are still holding a very small piece of this. 21 rolled over, holding the 50-day moving average. You're seeing a common thread here with these leaders, that the 21 very clearly has been pierced, but they're holding up the 50-day moving average, and the 50 is a very important technical level. If we hold these, we could form flat bases and come up the right side into year end. On the other hand, today's lows are critical. If they're pierced decisively, the market is going to take another one on the chin should that happen. LYV, Live Nation, very harsh hit today. That's a concert play, reopen, but again, undercut but reclaimed by the end of the day, the 50-day moving average, but the 21 is also rolling over. Ethereum, crypto, had a weak day. The flattened 21-day moving average closed below it, so taken off the list. Coinbase, if crypto's weak, you know, coins not having a good day. 300 is a big support area here, but again, falls into the list of broke the 21, 21 rolled over, holding above the 50. And finally, JB Hunt. This barely closed, but it did close below the 21. Really forming a nice tight flat base, keeping an eye on it. And speaking of which, let's go to transports. They gapped down today. JB Hunt's still one of the strongest of the transports. So break of the 21, and transports are, however, holding the 50-day moving average. Again, focusing on the key, what a key the 50-day is to a lot of these leaders that broke the 21, as well as the NASDAQ 100 and the S&P 500. So let's get to the 10 new ones, as well as the 11 that remained on the list. We've got 12 industry groups and 18 stocks on it. Let's first the 10 that were added. Qualcomm, big gap up on earnings here, and then a big follow through gap up day on 11/16. Big volume on the buys, decreasing volume on the sells. Broke the 80 MA, but still trending nicely above this pivot area here around the 168 level. And clearly, of course, above the 21, or it wouldn't be on the list. Unity Software, the other big software maker that is prominent in the metaverse, pulling back harshly from a strong run from 150 to 200, but a 50% retrace sitting here right above the 21-day exponential moving average. Pure Storage, huge gap up on 317% earnings. Well, not huge, it was a 14%, but a very nice break off of this 21 and 50-day moving average pullback. Did give back quite a bit of it today, but we're looking for healthy stocks in this market, and this certainly fits the bill. Zim, a lot of these are certainly not the strongest. You're going to see them pulling back over the last couple days, but in most cases, the pullback is on lighter volume, and it's holding the 21, and they're forming a constructive base. Zim, the premier rental shipping company, you see it's one of the difference between them and the shippers is they're asset light, which means they don't own a bunch of their ships, so they don't spend as much money for them, but and they're also very much into logistics. So Zim added to the list. Builder, construction, nice move up on earnings, day 2 higher high, continuing higher, riding the 8 EMA. Lulu, strong retailer, going sideways over the last 3 weeks after a nice move up, sitting right on the 21. Deere, not the best base, but going sideways, showed some relative strength this week with a positive earnings report. Tried to gap out above this 366 area, but the market held it back. But it did undercut and then hold the 21-day. Devon Energy, very clearly the strongest of the energy. We were in SU, show that, and got stopped out on it. Did hold up well relative to the other oil stocks. Another one that is very volatile but held up well is FANG. These held the 50 but are below the 21. I showed SU, but Devon is the one. If this is just a shakeout in energy, Devon is definitely the strongest of the energy stocks. You can see relative strength here near a new high before prices. That's always something we want to pay attention to, and definitely one that bounced off the 50 today, got back above the 21, so some good strength late, only down 5.3% on the day. While I mean, anytime a leader is down less than the ETFs that it's in, you want to pay attention to it. AMD, back above the ADMA, extreme strength here. Took some profits on this on the negative reversal. It's right about where we sold it. We'll be looking and look at how the relative strength has continued higher. Definitely a leader in the market, and semiconductors, I mean, ruling the world these days. They're in everything and really showing no signs of slowing down. Etsy, this is something we bought on Wednesday. Attempted to make a new high, showing extreme strength today, but pulled back 2%. Still looking really good though. And those are the 10 that were added. Still own Tesla sitting on the 21. Still own Nvidia sitting on the 8. Still own a little bit of Roblox above the ADMA. TTD we added this week at sitting on the ADMA and showed some nice relative strength this week. Zscaler sitting on the 21. New, held up very well relative to the other steel stocks, undercut but closed above the 21-day exponential moving average. Enphase, strongest of the solar stocks, above the 21, pulled back on really light volume the last couple days. Silvergate, their Silvergate network for crypto clearing continues to be a big revenue generator for them, undercut but got back above the 21. Signature Bank of New York, really nice, only down 4%, sitting on the 21 today. Cloudflare NET back above the 21. Harsh sell-off on Monday undercut that on Tuesday, nice strength on Wednesday, nice strength on Friday, still own a piece of this, and Datadog battling around the 21-day exponential moving average. Let me pause for a second here and bring in the balance at risk calculations that I want to show that we're using for our current portfolio. So once we bottom and start rallying, we want to track where the peak of the portfolio is off the bottom. So we made a low on 10-12 and rallied almost 13% off of that. So that's our benchmark for not wanting to draw down more than 8% off of that high with all the positions that we have. And we can do this with stops between recent lows, 8, 21, and 50-day moving averages, and a collection of ETFs that track the S&P 500 primarily. That's really the core of the portfolio, because when things start rotating, they rotate within the 21. That means, or sorry, within the SSO, within the S&P 500 is what I'm trying to say. Meaning if money comes out of tech and flows into energy, or out of energy and flows into industrials, that's all captured within the S&P 500. Now, if everything's selling off, then you'll see the S&P go down, and that's a sign to lighten yourself. In fact, we did with the close of the 21 have a hedge that was triggered on half of our SSO position. That's why the balance at risk here has been removed, because any dollar that we lose on this portion of the SSO is a dollar that we're going to make on the SPXS hedge. So limiting the drawdown to 8%. Right now, off the high, we're down 5.26%. We've got another 2.62% to go before we would all of our stops would get hit. So here's our position size. This is our position. The third column showing is the current gain. This is when we bought it, what we bought it at, the size of asset under management, which is each position size multiplied by or divided by the total portfolio. Where we would sell it, this was our stop, in other words. Sorry, this is the current price right here. It says sell because this is the price that we would, if we were, it's not it's not valid that it says sell. This is part of a bigger spreadsheet that when the sells actually get handled, they're reflected lower, but this is a portion of the spreadsheet that controls the exit. So this is the current price. This is the stop price over here. And this is where we are relative to the cost currently, what our AUM loss would be when we got stopped out. So it allows, we're always trying to remove emotion from the equation, but knowing what our downside is, that no matter what happens in the market, we're going to be within 8% of our all-time highs before we get stopped out, and having the confidence to maintain this, stick to our stops, reduce additional buys while the market is correcting, and focus on good entry points and good exits gives us some confidence to continue to execute the plan. Now, anytime we do a new buy or anything that we're holding, we will not have a loss greater than minus 0.2% to the overall portfolio, barring a huge gap down through the stop. So QLD, for example, the 5% position we took today in at 87.44, our stop is at 86.45. That would result, if it got hit, in a 0.19% hit to the overall portfolio. These remaining stops where we're slightly profitable or just barely down there, our stops are set on these. These stocks are acting well and were recently purchased. TTD, Etsy, up on the first buy, down slightly on the second buy. News pulled back. Tesla we're slightly negative on. We still have a 23% gain in Roblox, 10 and 8% gains in Net, 26% in AMBA, 63% in NVIDIA, 11.6 in Microsoft, 122 on our Apple buy, which was back right after COVID. But really what we're doing is, again, multiplying the stop by the position size, dividing that by the total value of the portfolio, and limiting ourselves to an 8% drawdown before we would reevaluate and attempt to get back in the market if the conditions were permitting. And this also accounts for putting an additional 8.7% to work in the market. That's built into this 2.62% downside. So down 5.2%, another 2.6% to the downside before our stops would get hit, or we would be fully hedged. And in the case of fully hedged, that's the rest of this SSO position if we would break the 50-day moving average. We do this for two reasons. One, so we don't have to pay tax on the gains there before it would hit a long-term capital gain. And the other reason is it's difficult to pivot from long to short and back to long all in the same day or week if we would need to, when it's much easier to just hedge, see where the chips fall. It takes all the risk off the table, and then just get out of the short if need be. So that's our current, these are our current positions. These are our stops to the downside, our current gains, and what our losses would be if they all get taken out. And certainly helps me sleep at night and the clients sleep at night knowing that we've got the downside protected. That's going to wrap it. If you have any questions, as always, I'd like to hear from you. I'm on Twitter at @DVandenbord. You can email don@revereasset.com. You can phone 855 Real Wealth. Wrapping up the week ending 11/26. This is Don Vandenbord telling it like it is. Thanks for listening. Have a great weekend.